You want to get started, Mark, or do you want to keep waiting?
No, ready to go.
Okay. First things first, can everybody hear me? Just either put it in the chat that we know that the mics are good. Okay, good. All right. Okay, cool. All right. Hello, everybody. Welcome to our program for Investing Basics for Women. Before we get started, just like to remind folks to keep your microphone either muted or turned off. And if anybody has any questions throughout the talk, please feel free to put them in the chat box, and then I can pass them on to Mark as we go along, or we'll do a Q&A session at the end. I would like to welcome Mark Lange back. So if this is your first time hearing about Mark, he started his career as an intern at developing computer models in the commodities markets. He learned quickly that this calling was not for him, as he enjoyed the reward for helping others. He then joined the American Express Financial Advisors. During his time there, he completed the Financial Planning CFP Professional Education Program, and he began training as a district manager. After moving on from the American Express program, he moved to LPL Financial. He is a past member of the Putnam Investment Gold Scale Council, as well as the Goldman Sachs Blue Chip Council as well. And he was the former host of the radio talk show From Wall Street to Main Street on our local WTBQ station out of Warwick. So I'm going to pass it all on to Mark. And anybody has any questions, like I said, just drop them in the chat, and then I will field them as we go along. All right, Mark, take it away.
Thank you so much. It's always nice to get back, as I like to say, in front of the folks who are trying to learn more and more about finances. Tonight, we're going to do Investing Basics for Women, and I will be your host. There's my contact information. I always post that ahead of time because when I do presentations on behalf of SOFA, you're entitled to an hour's free consultation. So if you have specific questions about your situation, I don't discuss them when we have these types of events, but you're more than happy to reach out to me. And as I say, you get a complimentary consultation. Let me tell you a little bit about SOFA. If you haven't joined me before, SOFA doesn't offer any financial products. This is strictly education only. I may use some specific items for illustrative purposes, but I'm not here to sell anybody anything. I'm here to do what? Educate you. This is what SOFA was designed to do. It's a nonprofit organization started in 1993, and it was designed to end financial illiteracy across America, one community at a time. Many, many years ago, we used to do these events live. And then COVID hit and we started to do these via Zoom. So I can't tell you how many Zoom events that I've done, but I'm hopeful that the information that I convey to you is helpful. Sometimes people will coin the term, he feeds us through a fire hose when I'm done. So I have 46 years in this industry at this point. So sometimes I can bring a fair amount of experience, should I say, to the calling. So I want to thank you all for joining me tonight. So let's get started. So what are we going to cover today? First part is knowing yourself. What does that mean? Are you an impetuous person, or are you somebody who's more pragmatic? So start to think about the type of person you are in relationship to all matters of finance. The key questions as we start to move forward is, do you use a budget? What type of debt management strategies do you use? And then ultimately, once we've taken care of those elements, what types of investment vehicles are there? What are the risk return characteristics of them? And then retirement. Why do we talk about retirement? Because by far, it is the single most important thing that you can do with regards to planning for your future. It's far more important than planning your children's education, and so much more important than virtually anything else that you're going to do. Why? You're going to need a sizable amount of assets in most instances. Why? Because pension programs, by and large, are gone. Most everything you're seeing today is defined contribution programs, meaning 401ks, 403bs, 457s, and the like. So it's going to be your responsibility to get yourself to the finish line of retirement. Why do women make better investors than men? I love this slide every time that I do this presentation. It comes with a big smile from me. First off, they do a lot of research. They're not typically a hot tip oriented individual. Makes my life a heck of a lot easier if somebody does research and has a fundamental understanding of the foundations of finance. I can help you easier if you have some of that knowledge. As the old saying goes, remember Cy Sims commercials, an educated customer is my best customer. I can help you to navigate those things easier. They generally have a commitment. They trade a lot less. They establish a game plan and they follow it. And as a result of trading less, what do? They save on the transactional costs and try to take advantage of the capital gains tax legislation. Now, that's an ever-changing element, but by and large, long-term capital gains is the primary orientation that we want to try to get to when we talk about long-term gains, and especially in non-qualified type portfolios. I'll talk more about that as we move further along. And in many instances, it's more than the numbers. In many instances, you're going to be investing in companies that you feel comfortable about, both personally and ethically. So it's an interesting element. Many of the things that women will purchase are companies that they've been familiar with using their products. So this is not an uncommon element. Now, as we talk about knowing yourself, are you a suddenly single individual as a result of some big changes? Are you a married breadwinner, meaning you are the one that brings in the predominance of the income coming into your household? Are you someone who's a contributor, yet you're not somebody that sits in the back seat? You're somebody there who's helping to make those decisions. And then lastly, are you the single breadwinner? And in many instances, there is a need for confidence here, because in so many instances, especially the first one and the last one, if you haven't had to deal with these issues before, it's an unknown arena, and sometimes it can be a bit overwhelming when you start, but it's not that difficult if we just go through it step by step. So, what are the key things that I want you to do when I think about an investing parameter? First and foremost, I want you to set realistic expectations. And as you can see, I've got a question mark at the end there. I can't tell you how many times I hear expectations that I look at people and go, how did you ever come up with that as an expectation? Well, I think expecting my portfolio to do 15 to 20% a year is realistic. Really? How did you come up with that? Show me some data that substantiates why you believe that. Second element, risk tolerance. Have you gone through a profile to help you to determine where do you stand on that risk scale? And are there areas that just because you fall into this particular comfort zone, it doesn't mean that you shouldn't take time to learn about the other areas that may enhance your returns over a long period of time. So you need to understand what are the risks that are associated with that. Next, what's the time frame that we're talking about? Are we talking about a short-term time frame, for example, purchasing a home in the next 1 to 3 years? Well, we wouldn't want to subject those funds in many instances to the volatility of the market. But if we're talking about a time frame that's 20 or more years out, we may want to use things that have much more volatility but give us opportunities for much better performance. And then lastly, what are you doing in terms of your budget and managing your debt so that you have available dollars to use to build that investment portfolio as you move forward? So when we talk about budgeting, and I always say this to people because typically I will get a lot of very young people coming in, either children or grandchildren from my existing clients, and they'll say, can you help them to develop a budget? Can you help them to structure a way to move forward that they can look back and have as a pillar to kind of move forward as a way for them to establish their financial house and get it in order? And I say, yeah, here's a simple one. Let's look at the right side of this slide. Out of the 100% of the dollars that come in, 70% goes to living expenses, 20% goes to debt, and 10% goes to long-term savings. Well, in many instances, I say this is ideal. Sometimes this particular equation doesn't fit for everybody, but it's a great place to start. It's a wonderful place to start. Your particular balance may be quite a bit different, but this is a wonderful place to start. Now, for younger individuals, for example, for young children, typically one of the things that we try to instill in them is what we call a third, a third, a third. So you have 1/3 that you're going to use for what? Buying something that you want to buy today. You're going to have another third that's going to go what? Saving for tomorrow. And then another third that's going to go where? To charity. Those are foundational elements that in many instances, when we talk about children, if we build their priorities out correctly in the beginning, it's amazing how quickly they will adopt them and they will follow through with those things as we move further along. So it's not just investing for women tonight, but also investing sometimes for the guidance elements that you'll provide to your children and your grandchildren as well. So let's start talking about different types of investments. And folks, there is a plethora of investments out there. And I'm going to start from what I'll call least risky and then work to riskier levels as we go through these lists. So the most common elements that most of you are going to be familiar with are checking accounts, savings accounts, money markets, credit unions. These things have typically extremely low volatility, extremely low risk, and extremely low rates of return. If you want to stretch out further on the risk spectrum by tying dollars up for a longer period of time, typically you can get a higher rate of return if you're buying a CD. So you're going to typically get a fixed rate for a fixed period of time. And then when it comes due, you'll have to see what the environment looks like again. You can use CDs both in a non-qualified account, meaning non-retirement type account, non-IRA, non-401k, so forth and so on, or you can have them in those types of accounts as well. So they're quite flexible from that standpoint. As we move further out on the risk scale, now we can start to look at bonds. And let's start at the bottom of these three. You have government, municipals, and corporates. Government are typically considered to be what? Risk-free bonds. So if you buy the bond and wait till it matures, you will get your dollars back plus whatever the interest is that's posted on a note, unless it's a zero coupon bond. However, governments don't default, so it is considered a riskless investment. However, if you want to sell it prior to its maturity date, there is a risk that the market may have changed its pricing relative to the value and type of pricing that that bond was issued at. Municipals work the same way. If you hold it to maturity, you'll get your dollars back as long as it doesn't default. Municipals can default, but they're generally extremely high quality, very close to government in quality. But typically here, we're getting lower rates of return than what we would get out of governments. Why? Because these provide us with some tax advantages. And then the next level up would be corporate bonds. These are issued by companies to help them finance their growth in many instances. And they, again, will have a term posted on them and they will have a rate or a coupon rate attached to them. They are more risky typically than municipals and governments. If we step up the next rung on the ladder, we'll talk about stocks. And stocks I'll typically divide into three basic categories: large company stocks, mid-sized company stocks, and small ones. Why do we divide them into those categories? Well, typically, very large company stock doesn't have the opportunity to grow, for example, as quickly as a small company does. So how do they provide those people who are participating in the ownership of the company with a return? Well, in many instances, they'll be providing dividends. That dividend stream for many people is the income component that they'll use to live off of while they're in retirement, or as a foundational strategy to build their portfolio out. So that will typically come from the largest companies. The mid-sized companies sometimes will have a combination of those dividend paying capabilities, but they'll also try to see the price of their stock appreciate in value, what we call capital appreciation. Those will have a combination in many instances of dividends and capital appreciation. Small companies are primarily capital appreciation. And as we go up that, or we go down in size of the company, we typically go up in what? Risk. because there's A, a lot more volatility, and B, a lot more potential for them to disappear from the face of the planet. Now, how will most of you go about buying these instruments, especially stocks and bonds? Most of you will buy it through either mutual funds or ETFs. Excuse me. Some of you may also use some closed-end funds, especially if you're looking for very unique or esoteric type products that are packaged in what we call finite wrappers. But for most of you, you're familiar with mutual funds. They'll be available typically from the biggest houses that you'll be aware of: Vanguard, Fidelity, BlackRock, T. Rowe Price. Those are some of the biggest institutions out there. And exchange traded funds, which are basically mutual funds, but instead of only trading one time a day like a mutual fund, where the value gets calculated at 5 p.m., ETFs trade throughout the day, just like an individual stock or an individual bond. And then the next area is life insurance, which I'll talk about in just a moment, and annuities as well. So let's hop on over to some additional types of investments that some of you are going to be familiar with. Real estate. Now, when I talk about real estate, most people think about owning their own home as the real estate component. But there are different companies out there and different types of companies like real estate investment trusts that people will purchase that are diversified portfolios that will give them the opportunity, depending upon the type of real estate they want to buy, to get a dividend income stream coming back. Also, you'll see today collectibles. Many people will have collectibles specifically as legacy heirlooms, stamps, art, and coins like that, but some people will actually use them as growth components in their portfolios. And then lastly, some hard assets like gold and platinum and other commodities that they may trade in the futures markets. And then today, the biggest change that most people are familiar with is the crypto elements, which today we hear them described as cryptocurrencies, but most of the analysts that I talk to that are dealing in the environment call them crypto commodities, because they have not been accepted as a standard of transferring payment that's universal throughout not only a country, but also globally. So a little bit more of a volatile element. Going back to the insurance, insurance generally comes in two types. One is just a death benefit. That's a term insurance. It doesn't provide any investment feature. Now, you can buy annual renewable term where you're just paying a premium each year for the death benefit amount, or sometimes you can buy it as a packaged product, like you could buy a 5-year, 10-year, or 20-year term policy where they will basically average out the premiums over that period of time, and it makes it a little easier for people as they get older to be able to afford that particular type of insurance. But what do you get? You basically only get the death benefit insurance. There's no investment feature. Okay. The second type is a death benefit with a cash accumulation feature, or what we typically call today permanent insurance. This cash value option comes in a couple of different forms. You can buy indexed universal life, where you will turn that cash value or the investment component of the policy. It will be driven by an index of your choice, and you'll participate in that index in a number of different ways. I won't get into the depth of that because that could be an entire presentation in and of itself. Whole life, which is the most common component that people are familiar with from when they were kids. Here, you're buying a death benefit, you're paying a premium on an ongoing basis. It's usually a static component, and over time, depending upon whether it's a mutual company or the alternative, you can get some additional dividends get thrown in to the policy's cash value based upon the performance of the insurance company. And then the last two that most people use today is universal life policy, which gives you the ability to adjust not only the premiums, but also the face value. You can always go down in face value, can't go up in face value usually unless you prove insurability. But you have flexibility as to the face value or death benefit component, and also the premiums and how they're paid. And then the last component is the variable universal life, where you're actually using what are called sub-accounts. They're similar to a mutual fund that's driving the underlying value that you get as a performance from that cash value or investment feature. The universal life, on the other hand, gets a crediting rate from the insurance company. So that's the big difference. Variable, you use sub-accounts, which are similar to mutual funds, to drive the value. Universal life, it's a fixed rate that's dictated by the insurance company itself. Risk and return, one of the key elements that we always talk about when we talk about risk and return is volatility. So as we can see just from this simple chart, the price of a security can change dramatically in either direction within a short period of time. For any of you who have been watching what's going on in the marketplace the last few days, you're certainly seeing that. The greater the fluctuation, the greater the risk. For those of you who aren't aware, if you owned Intel at the beginning of last week, and then you owned it at the end, still owned it at the end of this past week, you saw Intel see a tremendous drop in value. So this is something that I tell people, if you're going to be investing in individual securities, you have to have a little bit stronger stomach, because guess what? This isn't simple stuff, and you may have a high degree of volatility that you may have to deal with. So that's something you may want to look at before you ever decide the type of investment vehicles that you're going to use. Risk versus return, the two most common ways that people will diversify their risk is through diversification, owning many different types of assets, and asset allocation, where they're choosing specific types of asset categories to drive the value. So as you can see here, it's the owning of a wide variety of investments versus specific asset classes. Both of these strategies seek to lower risk, and quite frankly, in a number of instances, can be blended together. So there's a lot of optionality to these investment thought processes as you move forward when we talk about allocation of assets and how to do things moving forward. And it also has to fit within the risk profile and time elements that you're looking for relative to what you're trying to accomplish. This particular chart here just shows you some basic asset allocation themes based upon different risk levels. At the top of the columns, you'll see a description: conservative, moderate, moderate growth, and growth. Just below that, you can see the allocation that's to stock, the allocation to bond, and the allocation to money markets. So if we start all the way on the left and look at the conservative element, what do we see first and foremost? The majority of the assets are allocated towards bonds. Stocks have a much smaller allocation, but we still have an allocation towards cash. As we move into the moderate category, what's the big change that we see? We're starting to add more stock and reducing the bond exposure as we move up the risk scale from left to right. So this is something that you'll want to determine what's most appropriate to you based upon what are your objectives and timeframes. But this is a good guideline to start with. This is always an element that I tell people you have to think about. You cannot forget about this element, and I put it in red. It's taxes. And I say this for a very simple reason. Tax implications constantly change. Sometimes I think that Congress believes that the only reason they're there is to make legislative changes relative to taxes. But as you can see from this particular slide, dividends and long-term capital gains are taxed at a maximum of 20%. I always add the little asterisk. Currently, that could change because the Secure Act 2.0 sunsets in 2026. So we'll have to see whether or not those elements are moved forward, or if they're adjusted, or if they go back to what the rates were before we saw the Secure Act introduced. Short-term capital gains, meaning those elements that were held for less than a year are going to be added to your ordinary income. And as you can see here, most of us pay between 25 and 33%, but it could be substantively more, especially if you have a high income coming in. You could actually get, for many people who have very high income, 7 figures and above, many of those people are paying well above 40% as an annual tax rate on the income that they have coming in. So as I always tell people, try to pay attention to the silent partner that's always there with you. That's Uncle Sam. Your prosperity is his prosperity as well. Remember, he's there to try and get his piece if he possibly can. And a good deal of your planning as you move further along will be designed to do what? Tax avoidance, not tax evasion. You want to avoid those taxes legally. Now, as we plan for retirement, here's some really unique statistics relative to the ladies out there. Women earn on average 92 cents for every dollar that men do. They also tend to spend less time in the workforce, and most of the time that's because of caregiving. As a result, they usually receive smaller Social Security benefits. Women typically outlive men as well, and on an average, 7 additional years. The average age of widowhood is 65, and 1 out of every 4 older women live in or near the poverty level. Folks, when I teach about Social Security benefits and I teach about Medicare, I am often astounded by the confusion that I see people have with these 2 areas. It's not unusual for me because I deal with it every single year. But when I pull my Cliff Note guides, meaning I just get to the regulations without all the superfluous information, Social Security covers over 400 pages and Medicare is over 200. So I understand why people have difficulty. If you have difficulties in these areas, when I do those presentations, please join me. It'll help you to understand how to get through these areas. As we plan for retirement, one of the key elements that I talk to everybody about is maxing out your annual contributions to your qualified plan. Why? If you don't save for your retirement, who's going to do it? Also, for many of you, you have an option. You can do a pre-tax contribution, in which case you'll get a tax reduction for this current year when you make those contributions. Or you can do a post-tax, in which case you get no current deduction, but there's no taxation on the distributions. And as you can see, I put a little asterisk because there's a few specific elements that you have to deal with regards to the requirements that have been put in place for you to qualify for those no taxation distributions. A, account has to be open for longer than at least 5 years. Okay, one of the key elements, and you have to be over age 59 and a half, or you can have early withdrawal penalties because you haven't reached the age element. So 2 things to pay attention to. The other thing is, look at what the max to match is with your company. In other words, what can you max out at and yet still get the maximum contribution from your company? Important to understand those elements. It really helps. We call those qualified investments. So anything that's going into an IRA, a 401k, a 403b, a 457, anything that's a retirement plan, those are called qualified. Why are they called qualified? Because they're qualified by an Internal Revenue Code section. If they're not qualified by an Internal Revenue Code section, we call them non-qualified investments. And those are funded with after-tax dollars, okay? And in many instances, many of you will use your non-qualified investment vehicles to assist you during the distribution phase of your retirement. Now, when we get out there, one of the key elements that people don't understand is, why is it so significant to start early? Well, I have a lovely little piece that I always like to bring in here whenever I do this presentation. So you'll have to pardon me. I'm just going to step away from the presentation real quick. This is my favorite spreadsheet. As you can see on the left-hand side, we have the bright young investor, and on the right-hand side, we have the procrastinator. Both have averaged the 10% that the S&P 500 has averaged historically over its lifetime. The young investor starts out at age 20 and puts in a $5,000 contribution into his IRA or her IRA for 10 years, never puts another contribution in. The procrastinator, however, waited till age 30 and started doing $5,000 a year every year till age 65. I wonder who has more money. They're getting the same annual rate of return. Well, let's see. Well, if you started early, you only put in 50K and you had 2.4 million. But if you wait until age 30, you put in 180,000 and had $1 million less. Choice is yours, folks. The choice is yours. I can't get time back. When an interviewer interviewed Bill Gates and Warren Buffett and said, with all the money that the two of you have, what's the one thing that you wish you could have more than anything else? They both snickered, smiled at each other and said, time. They can't get any more time. So utilize the time that you have to be of the greatest benefit to you. And you can see, look at the difference of starting at age 20 versus age 40, just in this particular illustration. So it's the time that you spend having dollars invested in the market, not timing it. Let's talk a little bit about retirement distributions because I love this one, pure quicksand. When you retire, most of you have lost your primary deductions. You'll have lost your house deduction. Your children are gone, hopefully. You don't have pension deposit credits. You don't have any deductions for your contributions to your 401k, 403b, your 457. So you can see you're losing all these components that were deductions for you that help to keep your tax bracket in a reasonable level. Now, pre-tax contributions, when they get distributed, are what? They're 100% taxable. And they not only can drive you into a higher tax bracket, but they can also cause what we call IRMA surcharges. Those IRMA surcharges will determine whether or not your Medicare premiums will be higher as well. Also, those pre-tax contributions, when they begin to come out as required minimum distributions, may force your Social Security to be taxable depending upon how much income you have. So one of the key elements that I try to tell everybody, understand the tax implications that you're going to face by the planning that you're doing today and how it's going to affect you. But as the bottom point states, most people do not. And if I was to leave you with the greatest word of advice from my perspective after being in this industry as long as I have been in this industry, start early, plan ahead, and when you think about retirement 15 years out, that's the time to get serious about any serious changes you're going to make. Because if you wait until it's 5 years out, it's too late to change where you're headed in a substantive way. So very important to pay attention to those components. What are the next steps? Well, the next steps are for you to set some goals and develop a financial strategy and game plan as to how you're going to get from point A, which is where you're at today, to where you ultimately want to get to when you retire. More than anything, educate yourself on the options. Don't take what your friends say to heart. I can't tell you how many times I've had people come to different presentations and say, well, I've heard that. Well, where'd you hear that? Well, my friend was telling me that. That's completely off base. You need to read up on the things that are going to impact you. Develop a strategy to help you achieve those goals and plans. So for example, one of the things that I've educated many of my clients to do is when we have times like this where we see a great deal of volatility, in many instances, I will tell them ahead of time when we do our annual reviews in the beginning of the year, if we get a downside in this particular area, since I always have cash available on the sidelines to use, I'm going to put it to work. So I want to take advantage of these volatility elements if I can certainly do that. We always want you to evaluate your progress and adjust as necessary. Inspect what you expect. at minimum, be doing an annual review of your situation so you know where you stand. Are you on target or are you not on target? Very important. Normally, I'd say thank you very much, and please fill out the evaluation form. Give me an up or down, and if you have some positive comments, please turn them in. But we don't do these too often live anymore, so I don't have my evaluation forms for us doing them via Zoom. So that's all the information I wanted to feed you via my fire hose, and let's see if we have any questions that have come in. I'll look in the chat. If you have anything that you'd like to ask a question about, please pop it into the chat. Can I show the pie charts again? Yep, hang on a sec. This particular pie chart gives you a pretty broad spectrum from conservative to growth. So if you want to take a quick snapshot, go ahead and do that. Okay, let me see. What is the solution to the tax implications to retirement distributions? I'm not quite sure what your question is. If you put dollars in a pre-tax fashion, they're going to be taxable when they come out. The key element that you're going to have to do is coordinate when do you start to take them, which means if you, for example, let's say you retired at age 65, or let's say age 67, because that would be for most people who are born at age in 1960 or after, it would be age 67. What if you retire at age 65? Are you going to take a reduced benefit from Social Security? Are you going to take a distribution from your 401k? Which way would be the best way for you to go? Well, that depends on what your objectives are and what kind of taxation issues that you're going to face. So it's important for you to look at the spectrum of components that you have in there and what are your objectives. Is it just income for you, or is it legacy planning for your children and grandchildren? So those answers will determine the types of game plans that we institute to accomplish those objectives. What are annuities? Annuities are contractual relationships with insurance companies where you can either go into fixed type of annuities or variable annuities. Fixed type of annuities are where you put money either in a single premium or variable premiums where you're contributing on an ongoing basis into the contract, and then at some later date, post 59 and a half, you will take an income distribution from that annuity. During the years that it sits there, it will remain tax deferred until dollars actually come out. The hope is that you will build a greater amount of wealth before you actually go to do the distributions, and that tax deferral over many years will prove to be very advantageous for you. They typically come in two types: fixed rates, where the insurance company will give you a predetermined fixed rate. They'll usually do that every year, or they may give it to you in a multi-year product, or a variable annuity, which again uses sub-accounts very similar to the variable life insurance policy, and that will drive the underlying value. Any other questions? Okay, I don't see any other questions, so I will say thank you to all of you for joining in with me tonight. If you do have any questions or you do want to reach out to me, let me just kind of go back to the first slide if anybody wants
We
to
do
reach.
have one more. Are annuities considered safe?
Depends on what you're looking at. So for example, if I'm purchasing an annuity and it's with the largest annuity vendor in the country and it's a fixed rate, you want to look at obviously what is the assets that are backing the company. But again, annuities are not government based, so there is risk that's associated with them, and you certainly want to understand the quality of the company that you're using. So you can look at AM Best or S&P or even Moody's as a rating agency to determine what they think of that particular insurance company. But by and large, most of the insurance companies that are out there that are of a high quality that you know by name, Prudential, people like that, most of those are going to be very high quality. But I always urge people, please read the contract of the vehicles that you're using so you understand what it is that you're getting.
All right, and we have when do we need to start taking out from our 401k plans by law, or or if they force people to do that?
There is a requirement called an RMD, required minimum distribution, and that's predicated today based upon what your age is. So today, RMDs must begin by the age of 73, but in 2033, that age moves up to age 75. So that's when you're required to begin your minimum distributions.
All right. What is the best way to retire early? I know this is a loaded question, but what can be the best game plan?
I tell people the easiest way to retire early: start putting money away into a Roth account as soon as you possibly can, as young as you possibly can. That will give you the greatest opportunity to defer any taxation element and ultimately take the assets out tax free. But it's a question of how much do you have to put away into that vehicle as well as other investment vehicles. So you very much did give me the loaded question, but that's probably the best way to start in terms of foundation.
All right, I don't see any more questions yet. Did anybody have any final questions for Mark? Okay. Oh, where is anyone really making money in the stock market?
Well, I think the folks who have had good long-term track records, and I've been working with clients for many, many years. That the unfortunate, as I said to many of my clients who have been with me for a long time, if I do a good job, I'm going to create tax problems for you. Hopefully, long-term capital gains tax problems. So yes, there are people who make large amounts of money in the market. It's a question of what kind of game plan do you use, and are you going to let your emotions dictate, or are you going to allow your game plan to dictate to you how to take advantage of the market when the opportunities are there. But yes, people do make money. Absolutely.
Okay. All right. If there's no further questions, I'd like to thank Mark for coming out tonight to talk to us about investing. We do have investment books here at the library, so if anybody wants to start researching, we do have a good section to help people get going. And then if anybody has any questions for Mark, screenshot the screen, and then you can email him directly. But if no further questions, then we are good to log off for the night. So thank you all for coming out so much, and thank you once again to Mark.
Thank you all. Good night.